Welcome to Friday's Targets in Focus. I'm Elaine Stenson. I'm joined today by Gavin Wright, MD with EverFX in London, for his forecast for the sterling crosses for the next 12 months. The UK trade deficit narrowed in November. Separately, the Bank of England decided to keep its interest rate and the size of its quantitative easing programme unchanged, which was in line with market expectations. Gavin, with this in mind, what are your 1, 3 and 12-month projections for the pound-dollar pair?
Well, Elaine, in the United Kingdom, they're being guided by a thriving domestic labour market at the moment. The UK economy will maintain a robust pace of expansion throughout the first part of 2014. The pound sterling's poised to remain strong, though likely to lose some ground against the US dollar, we believe, over the course of the year, in view of the strengthening economic environment in that economy, accompanied by the gradual monetary stimulus withdrawal. Revisions to the historical real gross domestic product have pushed up the annual growth estimate for 2013 to 1.9%. The previous estimate was 1.5%. Though with an unchanged quarterly profile, the adjustment leaves our 2014 projection intact at around 2.5%. Growth currently being driven by consumer spending, net exports subtract from the headline pace due to the still weakening conditions elsewhere in Europe and the strength of the currency. With the wage inflation still quite subdued, the increases in household spending, we believe, have come at the cost of reduced savings across the board. However, unlikely to persist over the longer term as the housing market stabilises and the household disposable income growth picks up. Despite the rapidly falling unemployment rate dipped to 7.4% in October, the jobless rate is set to reach the 7% threshold as early as the first quarter of this year. The BOE will wait, we think, for signs of accelerating wage growth and improving investment and export prospects before considering any tightening policy. Nevertheless, we've brought forward the expected profile for the Bank of England rate hiking cycle, with the first rate increase coming as early as the first quarter of 2015. With all that in mind, Great British Pound, US dollar currently sitting at 1.6416. We see a gradual weakening of the pound against the dollar over the next 12 months, forecasting a price of 1.63 in mid-February, a possible decline to 1.615 after Q1, and dipping below the 1.6 to around 1.5850 at year end.
OK, and the pound-yen has a good chance to finish the first full trading week of the year in green. The cross is growing the fourth day in a row. The Bank of England's Governor Mark Carney made it quite clear that the UK does not need more QE, which means the Bank of England is among the most aggressive central banks of the developed world, in sharp contrast with the Bank of Japan, which will help to create longer-term GBP bullish sentiment. What are your expectations for the pound-yen?
Well, we actually have quite a strong opinion upon this. With the Japanese economy continuing to recover at a moderate pace, real GDP growth in the third quarter was revised down to 0.3% quarter on quarter, the earlier assessment of 0.5%. This led to a modest downgrade of the 2013 growth estimate for Japan. The country's output likely expanded by 1.8% in 2013 as a whole, and with a similar pace anticipated for 2014. We assess that the economic activity will record a marked pick-up in the run-up to April, particularly in terms of household spending. To cushion a subsequent adverse impact of the rate increase on domestic demand, the government approved in December supplementary fiscal stimulus measures worth 5.5 trillion yen, which was equivalent to quite a big 1.1% of GDP, which added to the previous package of 13.1 trillion put together in January 2013. The additional public spending will mainly be directed to infrastructure, we believe, and the stimulus package does require issuance of new government bonds due to a pickup in tax revenues that reflect the ongoing economic recovery. The consumer price index of all items less the fresh food increased by 1.2% year on year in November, up from 0.9% the month before, slowly approaching the Bank of Japan's 2% inflation target. Accordingly, the Bank of Japan will probably continue its quantitative and qualitative monetary easing into the coming quarters, expanding the nation's monetary base at an annual pace of 60 to 70 trillion. But with a combination of yen recovery and pound weakness, we feel it will probably pull this cross from a current price of 172.40, which is standing at right now, to 169.50 in a month's time. Further down to 166.15 at the end of Q1. and again below the 160 psychological barrier, and down to 159.10 at year end, Elaine.
And finally, the euro pound remains mildly bearish after both the Bank of England and the European Central Bank did as expected and held rates. The pound to euro exchange rate reached a fresh one-year high of 121.49 yesterday as investors reacted to a strengthening of the ECB's forward guidance. What are your forecasts for the euro pound?
Well, Elaine, the European currency map presents a divergent trend. The overriding influential factor is the expected strength of the US dollar versus both the developed and developing currencies in the region. Both the euro and the Great British pound will underperform the US dollar in the year ahead, we believe. The surprise of 2013 was actually the euro's strength. We expect this to be reversed this year as the European Central Bank keeps a dovish stance for longer than the US Fed, compounded by US growth outperformance, and investment portfolios with the euro long positions are very vulnerable in 2014, and this unwinding is likely to aggravate the shift lower in the euro. The nascent, yet still quite timid, recovery of the European peripheral countries may help to limit the euro losses as global investors possibly execute diversification strategies, mainly in the equity securities markets. With all that in mind, this is the one we're most confident about, the weakening of this pair. After a slight movement upwards to around 0.8315 by mid-February, we then see a following decline to 0.8105 at end of Q1, falling through the psychological support barrier of 0.8, potentially reaching 0.7950 at year end, Elaine.
Gavin, thanks for joining me on the line today, and that's all we have time for now. But Targets in Focus will be back next week, of course, so do join us for that. Bye for now and have a great weekend.